And the weekend was quite the surprise for the world. And we saw ramped up tensions between Israel and Hamas and a war announced. And now we have our second war in the European region. And this is an environment that we've been talking about for a long time where geopolitical tensions are ramping up. And that creates more volatility for markets, for asset classes, and especially for oil and all types of raw materials that are dependent on the Middle East. And so, this is something that when I say a new environment we're operating in, you have to throw out the old guard. We haven't had a war. When was the last time Israel and Hamas were at war? Was it the 70s?
I'm not sure the last time that there was an organized conflict versus the lobbing of missiles that typically happens, but it's been some time.
Yes, exactly. And obviously this throws Iran into it and Saudi Arabia and creates an environment that kind of harkens back to the 70s, where there's a lot of geopolitical instability within the Middle East. And of course, we're going to talk about all of this today and give you some unbiased perspective developed with over 20 years of investment experience. We're going to talk about the market performance overall. We're going to run down some show topics right after we answer our first caller question now.
Hi, this is Van from Coeur d'Alene, Idaho. I'm wondering what you guys are thinking about the old Apache. It's an oil company. It's now called APA. Thank you very much. Love your show.
All right, looking at Apache, this is an oil and gas name, and it's an E&P company. Been around for a long time. They produce crude oil, natural gas liquids, and natural gas around the world. About a $12 billion market cap, and up nicely today, as you would expect, on the back of what's happening in the Middle East. More tension in the Middle East, and about 4.15% today. Based in Houston, and this is a name that got into trouble due to some debt back in the day, but has kind of healed its balance sheet, and its business is strong. Luke, what do you think of this compared to some of the other E&P options out there?
Yeah, I'm seeing some increasing margins in terms of its return on equity. The gross margin has been up over the past 5 years, which is fantastic. However, I'd have to dig into it a little bit more because it looks like their average price to book tends to be around 10. It's sitting at 16 now. I'm curious if they, on their balance sheet, classify their assets in a way that makes it look like so much higher than the industry average. But generally speaking, I would expect, as we saw today, that the tensions in the Middle East and the uncertainty about future oil supply is probably going to drag all of these names upward. I don't necessarily know if this is the best one to go with. I would have to dig in a little bit more.
Yeah, I'm looking at the chart, and really since mid-2022, this has been in a downtrend compared to, I just look at the XLE, which is the broad energy ETF, and it continues to underperform. So while I think Apache is fine, it's a fine company. It has good cash flows, solid balance sheets, good assets. It's fairly large. It's repurchasing about 40 million shares of its stock, and that's about 10% of its float, a little over that. So I like that. I like the company overall. I just think you have better options out there in the oil and gas space. But thanks for the call. All right, now a lot of ground to cover the next 45 minutes, and time permitting, we're going to get to everything that we have on the docket, and that would be number one, our focus point, which is about the bond market rout and how bond prices over the past couple of years have, depending on what part of the bond market you're looking at, they've performed a lot like equities have at certain points in time. And so we're going to compare that and talk about the confounding influences that are pushing rates higher. Also, we want to touch on the dollar, and de-dollarization is a big term that people are throwing out there. And the question is, how real is the trend towards diversifying away from the dollar? Well, hint, it's a little bit of both. A little bit of hype, a little bit of truth. We're going to look at that. Also, subscription services and the tendency for the average person to keep their subscriptions going for an extended period of time, a lot longer than they actually use those subscriptions. So we're going to look at that, and maybe that will play into the businesses that deploy those models, as well as just from a personal finance perspective, how to think about your subscriptions that you do subscribe to. And then lastly, some large companies are going bankrupt. We're going to touch on a few of them and go over their impact on the overall economy and the jobs market. We also have some voice bank questions. One is on traditional versus Roth IRAs and the KBWP, which is the Invesco Property and Casualty Insurance ETF. We have some iTunes review questions to get to and our perspective for this Monday. And it's on the history of labor strikes here in the U.S. in light of the UAW strikes recently and Kaiser Permanente here in California, and many that are going on throughout the country. So let's talk about the market performance today. Luke, we had a nice rally in most equities today on the fact the bond market was closed, so yields fell in the futures market. They didn't actually fall because there's no trading in the bond market, but that certainly helped asset prices more broadly. But definitely the value side of the market, commodities, anything hard assets that are going to benefit from more geopolitical tension.
Yeah, we're looking at something that does not happen often this year, and specifically in the past couple of months, and that is small caps outperformed the S&P. So S&P 500 was down 5 basis points, so we call that flat, while the Russell 2000 was up 12 basis points, just over flat. That's a positive sign, as you typically see those names are most affected in times when you have credit crunches.
What data are you looking at? I'm looking at S&P was up 27 points, about 0.5%.
Oh, this is a little lagged, so apologies on that.
Your data's looking lagged over there.
My data's looking laggy. That's my sole job, is to be the data guy, and here we are.
Hey, you're the data guy.
Exactly. But generally speaking, I think you're right. A lot of the geopolitical tensions had an effect on markets. One other thing that had an effect is that the Dallas Fed's Logan said that if conditions remain tight, it may not be necessary to continue to raise rates, which is a positive sign that equities are going to like as well.
Yes, and that was the most under the radar data point or news story today, which was
for obvious reasons.
Yes, for obvious reasons. But that was certainly had an impact on the markets and the rally kind of in the afternoon. You were right though in the fact that small caps did outperform large caps today, and I think a big part of that was the rhetoric from the Fed, as well as the fact that if you have geopolitical tensions abroad, that tends to hurt more of your larger cap names, your multinationals, et cetera, whereas small caps, they tend to be more domestically focused. So that's a big reason why. And then a lot of the oil names are smaller. Yes, you have Exxons and Chevrons of the world, but a lot of oil names are more in the small and mid cap space as well. So that's something to consider. And just mining in general. Gold miners were up pretty nicely today on gold having a big rebound. Gold is a typical safe haven place to put money in times of geopolitical uncertainty. All right, now as we go to a break, let me remind you to check our new InvestTalk Classroom series. It is streaming for free on our YouTube channel, and episode 10 is up and is titled Index Construction. In today's world, with so many people indexing, auto-indexing through their 401k, et cetera, it's vital to understand how these indices are constructed. And some are market cap weighted, some are price weighted, but it's certainly important to understand your exposure through certain equities, certain parts of the market, and that'll help provide insight into the performance over certain periods of times, the risks that might be involved, as well as the opportunities. So learn more about the index construction and search InvestTalk Classroom on YouTube. And now my phone lines are open, waiting for your questions at 888-99-CHART.
When listener questions are played on the InvestTalk podcast,
how do you guys determine a value stock?
The caller voices are amplified many thousands of times.
Just wanted to get your opinion on JP Morgan and BAC.
How do you see this looking forward?
I'm 25 years old and have a question about retirement funds.
And the unbiased answers from Justin Klein.
That's why it's trading so cheap, because there's a lot of regulatory risk.
And Steve Peasley.
I kind of like it here. If I was going to buy Tyson Food, this is where I'd buy it.
Benefit the entire InvestTalk community.
Thank you for what you guys do.
That's why 24/7, rain or shine, no matter how simple or how complex, your questions make a difference.
Symbol BKE. What's your outlook?
And InvestTalk is made better by the power of you. So don't forget to call 888-99-CHART. You've got finance and investment questions, and Justin Klein and Steve Peasley are ready with their unbiased answers. Don't forget to call InvestTalk, 888-99-CHART.
All right, now our focus point looks into the story behind this question. What should investors do amid the rout in the stock and bond market? Now, stocks and government bond prices have tumbled as of late because of the Fed rate hikes, and the routes have been pretty historic, if we're being straight. Treasury bonds with a maturity of 10 years or more had notched 46% since March of 2020. Their 30-year bonds had plunged 53%. And that's pretty in line with how equities slumped in the dot-com bubble. They were down 49% peak to trough. And in 08, they're down 57% peak to trough. So what this shows you is convexity is a big issue. When you have low-yielding debt and yields go up, bond values drop precipitously. And everyone thinks of the high bond yields back in the late 70s, early 80s. And if you look comparatively, the losses on the underlying bonds are twice as big as they were back then, because bonds were going from a relatively high level to an even higher level. This is going from a very low level of rates to kind of middling level of rates back to kind of long-term averages at this point. And, the big question here is, what are the factors driving this? And what does it tell you about how to select different asset classes for your portfolio, Luke?
I think overall, one of the things that it tells us is maybe there has been over the past year or so some confusion in the bond and equity markets that allowed them to diverge. I think people tend to believe that bond markets tend to be really, really smart, but it seemed to take them a while to realize that rates were going to be higher for longer, even though the narrative from the Fed for some time has been rates are going to be higher for longer. So when that's the case, you tend to have the drag down performance in bonds at the same time that equity markets are also now pricing in the fact that bonds aren't doing well. That kind of seems to be one of the big drivers of what's going on right now.
Yeah, and I've seen how the market is pricing in long-term inflation, and they continue to price in maybe higher inflation than we saw kind of pre-pandemic, which was kind of in that 1 to 2% range, and it's pricing in closer to 2.5%. But I still think that's low. If you look in the history of inflation, you go back to eras of large government deficits and large government spending. Inflation tends to be much higher, 4 or 5%, et cetera. Okay, so after the break, we're going to get into maybe some of the other drivers for this, because these type of moves don't just happen because of the Fed wanting to raise rates. Now, that's part of it, but there are other factors where the market is starting to kind of wake up to this new reality of multiple data points hitting the bond market all at once and creating this massive sell-off in anything that's a long-duration asset. All right, moving into a quick break. The InvestTalk phone lines are open and ready for you at 888-99-CHART.
Everybody wants a secure financial future, but getting there takes strategy and discipline. And along the way, you're sure to have finance and investment questions. Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
All right, now before the break, we were talking about the catalysts for the bond market sell-off, the historic bond market sell-off. Now, Luke, you talked a bit about the bond markets maybe being wrong. Everyone says, oh, bond market's usually right. Well, just because they're usually right doesn't mean they're always right. And that's one factor, just being off on, I think, the trajectory of inflation and the economy as a whole. Now, government debt is certainly one as well, and that is the massive amount of bond issuance in the back half of this year, or the second half of this year. I think they announced in July that Treasury would be issuing $1 trillion in new debt. And that's certainly a problem. And it's not just the amount of debt, but the types of debt that they're selling. So earlier in the year, most of the issuance was in the very short end, selling bills, so 1 year or less. And a lot of these new issuance over the past few months have been longer dated issues, 5 years, 3 years, 10 years, et cetera. And so that's certainly a factor. Luke, can you think of any others that might have played into this route?
Yeah, I think it's really just the main point that I have to make is not that there's any one factor that's doing this. I think that this is a time where there's some unprecedented activity happening all at the same time. You're coming out of the pandemic. You have deficits that are running larger than they ever have. You have unprecedented government spending. You have supply chain crises happening because of global conflict. And it makes sense that markets don't quite know how to handle all of this complexity.
Yeah, it's an increasingly complex geopolitical environment, domestically and abroad. And the economic strength that we've seen as of late is also something that's confounding most investors, most people, saying, "Oh, interest rates are very high. The cost to buy a home is very high, and affordability is very low." And a lot of people look at the economy through that lens, as opposed to the components of GDP, the components of the economy as a whole. And so that new environment makes it very difficult for the market to really price in what reality is. And that goes, I think, to equities as well. So many people are caught off guard and are still kind of living in that old environment where the money just kind of flows into the exciting names, the FANG names, the tech stocks, et cetera. And you're still getting that to a degree, although that is wearing off just a bit. So what I see here is a confluence of factors that things are changing in a major way, but the average person, and thus the market, is having a difficult time kind of pinning down what that new environment really looks like. So that's kind of my take. But we're going to swing back to the InvestTalk voice bank for a question that came in earlier on 888-99-CHART.
Hi, Justin or Steve. This is Tommy from Nashville. Love your program. I really wanted to ask, my employer recently started offering a Roth 401k, and they've always offered a traditional 401k, which I've been contributing to. My question is, should I start to transfer my funds into my Roth 401k, or should I leave it in my traditional? I still do have a Roth IRA that I've been contributing to and maxing out every year. So any advice that you guys would have in this, I would be grateful for. Thank you so much. Love your program. You guys have a great day.
Well, any funds that you move into that Roth 401k is going to be taxed to you in that year. And that's the main issue that you have to deal with. So maybe you do some, maybe do all. That's more of a question for your accountant to see how much tax hit you want to take in that particular year. And if you're in a high tax bracket, you probably don't want to do that. You don't want to lock in that tax rate in that year. You might want to do that at a later date when you're not earning much income, maybe right after retirement before you hit RMDs. That's typically a time most people do Roth conversions. So something to look at, but probably not based on your age. It didn't sound like you were close to retirement. So I probably wouldn't do that. But maybe you start new contributions in that Roth 401k as well. That's something that you may be thinking about, and create that diversity. You said you already have the Roth IRA. You have a traditional 401k. you have some diversity there, but maybe try to find a balance there where you can get those roughly the same size. And then once you do hit retirement, you have the ability to kind of plan for which accounts you take money out of based on your tax rate, et cetera. So anything to add there, Luke?
No, I think that pretty much covers it.
Okay. All right. Well, we're going to head to a break right now. Thanks for tuning in. On the next Invest Talk, we'll look into the story behind this question. Are target date funds good investments? Some analysts are making the case that target date funds have been nothing short of the biggest positive development for investors since the index fund. That story tomorrow, but for now, I'm Justin Klein. I'm ready to take your questions now at 888-99-CHART. If you've been wanting to learn a new language because you have an upcoming international trip, or you want to develop a stronger connection with your family heritage, or maybe picking up a second language could make you a more competitive job applicant, then Rosetta Stone is for you. Rosetta Stone is the world's most trusted language learning program. Rosetta Stone teaches through immersion instead of memorizing and drilling vocabulary words. You learn by matching audio from native speakers to visuals, reading stories, participating in dialogues, and other practical language skills. Rosetta Stone can fast-track your ability to communicate fluently in your choice of 25 languages. Rosetta Stone has a built-in, patented speech recognition engine called True Accent. So, as you practice speaking, you'll get feedback on how well you are pronouncing words. Rosetta Stone can be used on desktop or as an app, or you can download lessons for offline use. Rosetta Stone helps you tap into your brain's innate ability to learn language and gets you comfortable with communication in real life. In fact, with millions of users, Rosetta Stone has helped all types of language learners reach their goals. Now, for a very limited time, InvestTalk listeners can get Rosetta Stone's lifetime membership for 40% off. That's 40% off. And you get unlimited access to 25 language courses for the rest of your life. Redeem your 40% off at rosettastone.com/today.
Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. That means you'll have finance and investment questions. Justin Klein is ready to provide his unbiased answers. So don't forget to call InvestTalk, 888-99-CHART.
Hey, Justin, Steve, or maybe even Luke. This is Nick from Seattle, and I'm calling about McDonald's. This stock is an absolute falling knife right now, but it's starting to get really interesting. I know that restaurant, leisure, and travel is an out of favor sector right now, but this stock seems to be getting somewhat cheap to me, especially based on historical levels. They're supposed to grow revenue next year. They're buying back stock. Their margins are increasing. So I don't know, what am I missing here? How come this thing is completely falling out of bed? I'm seeing that major resistance comes in around 240, and if it trades sideways around there, I may add McDonald's to my portfolio. Just calling to get your opinion. What's your thoughts on the sector, and what's your thoughts on this individual stock? Thanks, guys. I'll be looking forward to hearing your answers on the show.
All right, looking at McDonald's, and McDonald's certainly is in a free fall. And part of it has to be that here in California, they made the minimum wage for all fast food workers $20 an hour. Isn't that correct, Luke?
They did, yes.
Yes. So certainly that's going to hurt McDonald's itself. And this was trading also at a pretty high multiple compared to its history. And when interest rates go up, multiples kind of contract. You also saw consumer staples and their type of companies really take it on the chin as well. So, McDonald's is your kind of typical income type of investment because their business is so steady. And higher interest rates have hurt them as well. Went from 300 just during the summer. Now we're at 250. So it doesn't sound like a big drop, but for McDonald's, that's a pretty volatile move. Luke, do you think that it's cheap enough yet after this about 17% drop?
McDonald's is an interesting company, right? Because the way the business model actually operates is, I still believe it's the largest real estate company in the world, right? So they purchase the land underneath the restaurants, they franchise out the brand, and they control the brand by owning the land itself. So if you look at its price to earnings, it is coming in below its 5-year average of 29. Its price to cash flow is also below those averages. I'm not sure if this is the exact point you'd want to buy it, given what's going on again with the uncertainty of legislation and risks associated with that in California. But it does seem to be, compared to its historical valuations, near that point.
Okay, so it's kind of reverted to the mean, and it is near some support. I will say that if you look at the weekly chart, this is where it kind of broke out from back in late 2022. So, it's still in a longer term uptrend. My worry is secularly, just how much more pressure will they get from the cost side? We know food prices are going up, and now you have labor going up as well, and that will structurally change their business model overall. Now, like you said, Luke, that a lot of that's real estate, but commercial real estate prices are coming down. Now, they typically own actually some of the most attractive types of real estate, which are those small single tenant retail locations that are in high traffic areas. They're not office real estate, so that's kind of a positive. Overall, I would say it's just not cheap enough quite yet, and I don't like the recent trend. This is a pretty large pullback on volume, and to me, unless this can reassert itself and start an uptrend again, I would not own it quite yet. All right. Thanks for the call. 888-99-CHART, 888-992-4278 is how you get through and ask your question on today's show. Now, my perspective today looks in the history of labor strikes, as we are seeing ongoing labor negotiations in many industries. And a strike is simply an organized work stoppage conducted by laborers in order to impose bargaining power against its employees. And strikes are usually cumulative grievances, right? Where it's not just one thing that's been a problem, it's multiple aspects of their jobs that have compounded over time to create a level of strife within the workforce that precipitates a strike. And it can be usually it's set off by wage increases that don't keep up with inflation, which you can see that now, Luke, in the way you look at wage growth. Early in the pandemic, the lower rungs of society and their jobs, they were actually keeping up, in many instances outpacing inflation. But as of late, that hasn't been the case. And so it's causing these workers to stand up and strike.
Yeah, I think it actually goes back a lot further than that. I think one of the things that has caused this, what I've dubbed to you in the office as the season of the unions, if you will, and certainly not one that'll last months, but probably last some time, is that in the wake of the recovery from 2008, which was a long expansion, it was disproportionately pushed away from the same type of workers that are striking today. And so when they're seeing record profits at auto companies and they're seeing record profits at some of these businesses and they're not sharing in a way that they think they should be, of course, that's going to cause them to want to organize in a way that you haven't really seen since the early 1900s. And the most interesting part about that to me is just the support they have. 72% of Americans now sympathize with the television writers. Overall, 67% sympathize with unions in general, which is a pretty large majority.
Yeah, and this also jives with what I've been saying for a while, which is the demographic shifts in the country and really worldwide are going to shape the next decade, probably a few decades, until those demographics shift back the other way. And what I'm saying is the majority of baby boomers are retiring, or have retired, which is, and there's not enough of the younger generation, both millennials and Gen Z, to kind of fill that void. And therefore, these workers have a lot more bargaining power than they have in the past when the boomers were a large part of the workforce. And, with deglobalization, that's another aspect where more and more people are trying to, or more and more companies are trying to solidify their supply chains and bring those back either through sheer will or through the carrot approach from government. And that's if you talk about the CHIPS Act and the Inflation Reduction Act, obviously there's a lot of carrots there for that to happen as well. So you have a lot of confounding factors that are pushing these strikes, and I don't think they're going to end anytime soon. Now, currently, 25,000 union members at 5 assembly plants and 38 parts distribution centers nationwide are on strike. Now, if you look back in history, Luke, the first major strike happened in 1886, and this was the Great Southwest Railroad strike. This was in Arkansas, Illinois, Kansas, Missouri, and Texas. And like I said, there's about 200,000 workers. In 1902, you had 147,000 workers. The Great Anthracite Coal Strike. Anthracite, there you go, anthracite coal strike started when 147,000 coal miners were a part of the United Mine Workers of America strike in eastern Pennsylvania. And then you fast forward all the way to 1922, you had 350,000 workers on strike. And this is when the National Guard actually came in. This is the railroad's shop worker strike of 1922. And they tried to cut their wages by 7 cents. And the National Guard came in, and there was a lot of violence, and it ended with them only getting a 5-cent cut. So it was really over 2 cents an hour. And then you fast forward to some of the bigger strikes. The steel strike of 1959, 500,000 workers. Think about that compared to just 25,000 now. This is a very small strike in history. Now today we have 75,000 healthcare workers that walked off the job last week at Kaiser Permanente here in California, the nation's largest nonprofit healthcare organization. And altogether, there have been 312 strikes involving roughly 453,000 workers so far this year, compared to only 180 strikes and 43,700 workers over the same period 2 years ago. So think about more than a tenfold increase in the number of workers that have walked off the job over the last 2 years. And what happened over the last 2 years? Inflation went up big. So to me, there's a clear correlation here with inflation and people not feeling like their employers are keeping them up with that inflation.
Yeah, and I think one thing that's going to exacerbate this is probably the success of the writers and presumably the success of the actors shortly after that.
Yeah, exactly. So it's pretty clear that they are earning concessions. It's just a matter of, it's going to vary depending on the industry, but it's a matter of how long they're able to hold out. And, I think also how profitable is the industry? Is there room for these hikes or not? And so, you're starting to see that corporate profit margins remain near record highs. They've come down from their peak a couple of years ago, but they still remain near record highs and well above longer term averages. And so, I think there is a lot of room for many industries to pay their workers better, and that ultimately means higher inflation. That's going to be passed on to the end consumer. All right. Now let's touch a bit on the dollar. And de-dollarization has been a popular term. And the big question is the rest of the world, are they getting very far? Now, the percentage of official foreign exchange reserves allocated to U.S. dollars globally was 58.9% in the second quarter. Now, that's broadly unchanged from a 25-year low first reached in the fourth quarter of 2020. So the trend over the last 5 years, has been down. In the late 90s, we were hovering in the low 70s of foreign exchange reserves held in dollars. Now we're in the high 50s, right around the 60% range. So, Luke, based on the numbers, is the rest of the world actually doing a good job of weaning themselves off dollars?
Well, I think you have to put this into the backdrop of what's going on, right? So over the past 25 years, you've had the rise of the euro. You've had the rise of the Chinese yuan or the renminbi trying to displace the dollar. And when you take a look at the trend over the past 25 years, if anything, I think it's slower than those countries that are trying to de-dollarize the global economy would like.
Well, it's slower because if you look at the amount of debt that's issued and the type of currency that it is denominated in, it's still, but 70+% of debt that's issued is denominated in dollars, which tells me that, hey, if you're going to lend money, currency of any kind, you're going to get paid back in any type of currency. Which currency do you have the most faith in over the coming years? Because it's not about today, right? You're lending money, you're getting money back in the future. What dollar are those, or what currency are those banks, institutions that are lending that money out? What are they wanting to be paid back in? And it's still widely dollars. And remember, those loans are now assets to whoever lent it. And so if you look at total dollar denominated assets, it's largely unchanged. But when you're looking at trade flows in certain aspects like oil, for example, that is being increasingly de-dollarized, and it is being transacted in other currencies. So China and Russia, for example, they're mainly trading in euros as well as yuan. And so it is happening, but it's a lot slower than most people want to really admit, because I think most foreign countries, foreign institutions, they don't want to be beholden to the dollar, but really they are.
Yeah, I think you also have to look at some of the reasons why these countries have been dropping U.S. treasuries over the past year. Is it related to their plan to de-dollarize the global economy, or is it really related to just generally wanting to exit the government bond market, given the mass amount of issuances at higher interest rates compared to historical bonds?
Yeah, a lot of people will quote the amount of bonds that China is holding, but a lot of the recent drop is simply bond prices going down. So it's just showing the current value of those bonds on their balance sheet. And then they've also been buying things like mortgage-backed securities as opposed to simply treasuries. And they've also been huge increases. You've seen huge increases in holdings in places like Belgium and Luxembourg. And a lot of people, you don't know this, but a lot of people surmise that is actually where China is buying those issues of treasuries. So are they really diversifying? It really doesn't look like it. Remember, China benefits from this relationship. For the past 25, 30 years, it's all been about U.S. running a trade deficit and China running a trade surplus. They're taking that surplus and reinvesting it in U.S. treasuries, allowing us to run a continuous deficit and thus strong economy that will buy more Chinese goods. So it's been kind of this virtuous cycle that I don't know if China wants to break that, because what do they have else? What is their alternative to this system is the big question.
Yeah, I think one of the reasons why people want to break the system is something that we've talked about before, and something that I've talked about before, which is the soft power of the U.S. government, right? Rather than using hard military power, they come in with economic sanctions, and that grip and the ability of them to do that is based upon how important the dollar is to global trade. But the countries that would most like to see that power taken away are also not the countries with a large share of global trade. Look at where the Russian economy has gone over the past 20 years. Look at Iran. All these countries that want to de-dollarize, they're not as incentivized to, or rather China is more incentivized to keep the dollar, because they aren't really the subject of the type of crippling sanctions that these countries that don't have that large share do.
Yeah, they're not benefiting from the current system, and they would love it to change. All right, now this is InvestTalk. I'm Justin Klein. We have one goal here each and every weekday, and that's to help you achieve your own version of financial freedom. And our work continues after this final break. So get your questions in now at 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Hey, this is James
Georgia. Really love the show. This call is for Steve or Justin or Luke. And I was trying to call you guys about Verizon. I've got Verizon in both of my portfolios. It's down almost 23%. It's one of these stocks that I was hoping to just hold forever. And I'm curious, is it something I just need to be patient with, keep holding it? You think I should exit it? I greatly appreciate your advice, and I look forward to your answer on the show. Thank you.
All right, looking at Verizon, I don't think I need to tell everybody what Verizon does, but we know Verizon is a part of a, what do you call it, where there's three main players in an industry, Luke? Not a duopoly, but...
Triopoly?
There we go. I can say triopoly. There we go. And they have a lot of debt. That's the simple issue here. And they're in a very competitive business that T-Mobile has been trying to take market share and has been able to take market share. And it yields 8.5%, which everyone's going to look at and say, oh, that looks amazing. But, are they able to continue to pay that with this level of debt load? And this is the perfect example of the type of name that you want to try to avoid in this market. I'm a huge... I came to this conclusion a couple weeks ago, and it's pretty clear that most investors, especially those that are focused on income, are way off sides when it comes to the type of names they're looking at. They're looking at the dividend yield, and they're saying, oh, I want that dividend. I want 7, 8, 9%, whatever, right? But they're not looking at the structural forces that are making these type of companies with a lot of debt a lot less profitable and structurally weak. And so this is the perfect long duration asset that I think is going to continue to struggle. Now, near term, I think we might be at a point where you get a bounce in these type of names. You might get treasury yields to fall, and you get a little bit of a rally here. But these are the names that you don't want to own longer term because of the higher interest rate environment. What say you, Luke?
I like the way you phrase that. You should do that more. But yeah. I think from an industry perspective, the problem is that the future is 5G, and Verizon slipped into third behind T-Mobile and AT&T in terms of coverage. And because of that, they're losing a lot of customers. And that's not good to shed customers when you have high fixed costs to operate because you have a lot of debt. That's what's going on with Verizon. From a general perspective...
And to catch up, it's going to cost them a lot of money.
It's going to cost them a lot more money, which means more debt or more shares. But I think from a larger general overview of investing, too often people tend to stay married to their losses and divorce their winners. And this seems to be a situation where it may be that you're too married to your losses.
Yeah, I agree. But like I said, is this the time to sell it? This would probably be for a trade. It's probably a good stock for a trade if treasury rates fall, because you're going to get some nice tailwinds because that's one thing that's been weighing on this name as of late. So if you get the opposite happening, right, rally in bonds, sell off in yields, then that's certainly going to help a name like Verizon. So timing wise, I probably wouldn't sell it, but definitely not a name I want to be holding longer.
Correct.
All right, let's touch a bit on this subscription model. And there's a lot to be said about behavioral economics, but there have also been many studies recently on how easy it is for these subscription based companies to get people to sign up and keep their memberships going, even though they may not even use their memberships in any way. And that obviously happens a lot in the streaming world. The original place it happened was with gyms. Most people sign up for gyms. They're very optimistic on how much they're going to use them, and they use them a lot less than they typically do. I know, Luke, you're a serial subscription canceller and resubscriber. So, what does this say about the subscription model overall and the businesses that run them?
Yeah, I think there's two lessons to be had here. One is a personal finance lesson, and that's be careful where you're spending your money. I just found out the other day that I'd been paying for an AMC Plus and Cinemax subscription through Amazon Prime because they didn't notify me they were charging me, even though I did a free trial, which I guess I just forgot to cancel. Luckily, I was putting all my expenses onto a new credit card to get those welcome bonus points. Always a good thing to do. And I learned that. So be careful where you're spending your money. From a business perspective, I would say also tells me that there's a lag between when people want to cancel and when businesses are going to recognize the losses in revenue. So be careful with these streaming services. The bottom might not be here.
Yeah, I agree. I'm not a huge fan of the multiples, at least, that these streaming services are trading at. All right, I'm Justin Klein with Luke Guerrero. Let's complete another InvestTalk program. Steve and I thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to like and subscribe to our channel. All right, independent thinking showed success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of